Let's get to the UK macro story. The economy shrank more than expected in the month of October as elevated borrowing costs have started to take their toll. The figures add to fears that Britain is stuck in a long-running stagnation. Let's talk to Dan Hanson of Bloomberg Economics. He's got his views, can take us through them on what this data means, where it takes us. Dan, let's just deal with some of the easy-to-deal-with things. I mean, how many one-offs are there? I seem to remember, I mean, the weather always plays a role. Was it warm in October? People didn't buy coats. What was the weather story that we need to sort of strip out of these data?
It's always the case, isn't it? The monthly GDP numbers, we blame the weather. But this time it was wet weather. Okay. So that's one of the reasons why possibly it was a little bit weaker than expected. I think if you look at the sectoral breakdown, though, it looks broad-based, this weakness. It doesn't look like a set of one-off factors. The weather might have played somewhat of a role, but I think looking at it this morning, it was weaker than we expected, weaker than all economists expected. As I say, it was pretty broad-based, that weakness.
And does it change you and your view and the team's view in terms of where the BOE lands? Does it bring it forward?
Yeah, that's a really good question, Tom. So I think we've got the first cut coming in August next year. Now, you look at this data, you look at this data, you look at what we had yesterday on the wage data. Obviously, the risk is that it's a little bit earlier. But I think the thing that we have sort of weighed in our forecast, and we've got a very weak GDP forecast, but it's set against a strong inflation forecast, and it's sort of how do they balance that and where do they land? Now, I think our forecast says they hold their nerve, they being the Bank of England, hold their nerve, and they really focus on the inflation story. But you have to remember, election year, if the economy is weaker than they expect, the risk is it is shifted forward. Now, how much will it be shifted forward? I think the earliest it could come is May, because they'll want to see the March budget. There's some hopefully good inflation data coming in April, May next year. So they're going to want to see that come through before they go ahead and cut. But I think May's the earliest point, but at the moment we're still on August.
OK, and just looking at where we are on CPI, I mean, we're at year-on-year figures of around 4.6% for the UK. So, yes, if you're the Bank of England and you're thinking that's still way above target, isn't it? It's way above a 2% target. But is it... Where is the level that you think really makes a difference for the Bank of England? What kind of inflation can we get down to where the Bank of England says, OK, now we really need to focus on the weak growth story, even if inflation is higher than target?
So I think over the next few months, probably to March, we think we're going to stay at 4.5. April, May, you're going to get a pretty big drop. Because if you remember this year, we had this massive spike in core inflation. If that isn't repeated in the way the annual comparison works, we're going to get a drop down to around 3, maybe even 2.5% if we're sort of with a fair wind. And I think that's the point, as I said to Tom in the previous question, that's the point at which they'll feel comfortable that with a weak economy on the other side of the trade-off that they're looking at, they'll be OK cutting rates potentially.